go back to the basic. I'm going to give you an overview of what exactly private credit is. When a company needs to borrow money, you used to go to the bank and borrow money. After 2008, the rules on banks got very strict. So a new industry stepped in. It's called private credit. Private credit is just loans made by funds. A bunch of investors, they're pulling together, they lend the money. That's their main thing. But they are other aspect to it. They don't have any bank branch, no regulator watching daily. And here's the key part: no market price. Nobody can trade these loans. No one can decide their worth. On the other side, private equity. Those are the firms that buy whole companies, but by using borrowed money. Over the last decade, the same firm started doing both. They buy the company and they run a fund lending to other funds, a family of firms, both sides of the table. That's the machine. Now, here's what's get interesting. This entire machine has been supercharged by one thing: the AI build out. Data centers, chips, billions of dollars of construction everywhere. A huge chunk of it, it's not funded by bank, it's funded by private credit. And here's just a number from all the filings of the five biggest tech companies where they have signed over $662 billion in data center leases that don't even show up on their balance sheet. That's bigger than all the debt they do show. Now, the part nobody talks about it, the chips inside those data centers. The NVIDIA GPUs last about 3 to 6 years. The leases on the building runs about 15 to 19 years. And the money funding it all, a lot of it comes from insurance companies backing retirement promises that run 30 years. Yes, you heard it right. Life insurances, retirement money, retails. So a 3-year chip funding a 15-year lease, funding a 30-year retirement promise. Now, who's holding it back? So where does the risk actually sit? Not with the banks. Europe's central bank has stressed this banks barely got scratches. The biggest losses landed on insurance companies and pension funds. Why insurers? Because they need long-term investments to back your annuity, your pension, your retirement check, all that. And private credit paid more than government bonds. So they loaded up